For managing current assets, this is a very interesting topic. What are the current assets? If you see the statement of financial position, previously we called it as balance sheet, has long-term assets, short-term asset, or non-current or non-current assets. So this chapter is purely focused on non-current assets, which is useful life is less than 1 year. What assets those are? These are your inventory, your receivables, your cash, your bank, right? So this is what is, we'll discuss the concept of working capital and how important this is. Then we'll see that assets like cash, marketable security, how to manage. We'll see how to make a portfolio and receivables and inventory. This is what is the topic of the day. Starting with working capital. Working capital is in formula, it is current assets minus current liabilities. So we say that you should have more assets, current assets versus your liabilities, because otherwise you will be in a difficult situation and you have to arrange alternative sources of funds. Working capital shows your liquidity, so your liquidity should always be good. Now it depends upon your style. There are two styles to operate. One is aggressive working capital policies and one is conservative working capital policies. For example, if you are a management and you tell your finance or accounts department that at least 3 months monthly expenses, that is like your salary, your other expenses, should always be in the bank account as precautionary. So means you are a conservative management and you keep a higher level of cash flow in your entity. Opposite, we have aggressive policies. We go net to net, so we don't keep a lot of money in our accounts, and every time we are, struggling and saying, but of course aggressive policy has its advantage and disadvantages, and conservative policy has its advantage and disadvantage. This is shortly we will discuss. So working capital finance concerns the optimal level, mix and use of current assets used to acquire the current liabilities. So objective is to minimize the cost of maintaining liquidity while guarding against the possibility of technical insolvency. So effective working capital policy is very much important, because if you don't have, suppose you have a very good home, you have a very good Lamborghini or something, and you don't have money to fuel it, so you are sitting at home that how to go outside, because all money has been invested in the capital assets, right? So that's why we have to see a company from all angles. When a credit prepared proposal, they see your profitability ratios, they check your liquidity ratios, they check your solvency ratios. If it is a listed company, then we will see the market ratios as well. That will tell us from all angles that should we lend or not, right? So he says from an analyst point of view, working capital equals current assets, right? But from finance point of view, it is current assets minus current liability. Always accounting go as per US GAAP. There are standards that we have to follow. Finance use the utilization and optimization concepts. This is we saw already that we may be in accounting profit, but when we see economic profit or loss, we may be having an opportunity cost which will be too huge, which accountant don't consider, but as a financial analyst, you do look into. Then we have, as I told you before, conservative policy seeks to minimize liquidity risk by increasing working capital. So you are a kind of person. Actually, we know there are 3 types of people in the world. One are aggressive, one is moderate, and one is conservative. So when you as an investment bank or a proposal, if you have proposals for investors, this guy, when you will tell him high risk product, He will say, no, I need surety. I need less return, but I need to guarantee my investment. So you will find three type of investors. That is called aggressive, moderate, who are calculated. They take some risk and some non-risk products, and one is totally aggressive, that they invest in non-traditional and alternative products. Same way, suppose if I am going for a shopping, if I don't take my purse, I just take a card and go, means I'm an aggressive person in terms of my spending, because first of all, card has no limit. Second is no limit means cash has 10,000, 20,000. Card might have 150,000. So I can spend more as the need. But there might be a possibility that there is a telecommunication issue and card is not accepting, machine is not accepting the cards, right? So that time I will say, I might carry some cash, it can make my life easy, right? But this situation I will not face every day, so I will say, okay, if once in a year, once in a quarter, if it happen, no problem, right? This depends on my psyche, consumer or investor preferences. Second is, there are people, like generally parents, when you go out of the home, they will give you some instructions, right? For example, have you taken your money? Everything is aligned. They will have a pre-test. So they are little bit conservative, doing a conservative test for you, that you are well prepared to go outside, So it's about investor attitude. So if you are in a company, they believe that they should avoid or minimize the risk of non-payment. Like someone comes here, asks, I need $20 for a small work he did last month, and if you see your petty cash, you don't have cash, so means you are an aggressive working, then you will say, okay, we will arrange, come tomorrow, we'll pay you, right? But opposite, when there is enough cash, every 3 months you have a policy that you have to keep the expense for 3 months. So that will show that you are a conservative and you are a planner, But I will say, I may challenge that you have an opportunity cost of doing that. So this is, you have to keep. And he says higher current ratio means your current asset will be higher versus your current liability, because you will keep more bank balance or cash or convertibles.